Oracle just reported the best revenue year in its entire history. Revenues up 17% to $67.4 billion for the year. Cloud infrastructure up 93% in a single quarter. And the stock dropped 6% after hours. That tells you everything about today's market. Good news wasn't good enough. Because everything else happening right now, war, oil, inflation, is drowning it out. Today was a painful day across global markets. Here's exactly what happened, what it means, and where the opportunities are. Before we get into the numbers, let's understand the backdrop. Everything today traded off one story: the U.S. and Iran. Overnight, the U.S. launched fresh self-defense strikes against Iran. The reason? Iran downed an American Apache helicopter near the Strait of Hormuz with a drone. Iran retaliated. It struck U.S. military bases in Bahrain, Jordan, and Kuwait. President Trump said Iran would have to pay the price. Iran's foreign minister said no attack would go unanswered. Markets opened in a bad mood, and they more or less stayed there all day. The Strait of Hormuz, the world's most critical oil shipping route, remains heavily disrupted. Around 31% of global seaborne crude passes through it. Brent crude opened the day swinging around $91 to $94 a barrel. It settled around $93.95 by close, up 2.74% on the day alone. And this comes on top of a market that's already been rattled all week. What most people don't realize is the oil move isn't just about energy. It's about inflation. And inflation is about interest rates. And interest rates are about every single asset on the planet. That chain reaction is exactly what played out today. Before we get to what happened on Wall Street, I need to tell you about a number in this morning's inflation report that completely reshuffled the rate expectations game. That's next. At 8:30 a.m. Eastern, the May CPI report landed. Annual inflation came in at 4.2%. That matched expectations. Monthly inflation rose 0.5%. That was also expected. Core CPI, stripping out food and energy, rose just 0.2% for the month, actually below forecasts. On paper, that sounds like a relief. And briefly, futures paired their losses. But here's the problem. This data is for May. The oil shock is June. The energy price surge driven by Iran hitting the strait, that feeds into June data, which hits next month, which is almost certainly going to print hotter. The Fed is not about to cut rates. A 25 basis point hike before year-end is now fully priced in by markets. The 10-year Treasury yield hit 4.55% intraday. It settled at 4.52%. The 30-year is sitting just above 5%. Those are restrictive levels. Expensive borrowing, slower growth, less money chasing tech stocks. And that's exactly what we saw on Wall Street today. The S&P 500 closed down 0.48%. The Dow Jones fell 0.59%. The Nasdaq dropped 0.62%. Small caps, the Russell 2000, actually gained 0.41%. That's a rotation signal. Money moving away from growth into value. In terms of individual names, Chevron was one of the top gainers in the Dow, up over 1%. Coca-Cola added 1.5%. Verizon nearly 1.5%. Defensive stocks holding up as tech bleeds. Salesforce, 3M, and Honeywell were among the worst performers on the day. The FTSE 100 ended the day essentially flat, down just a fraction near 10,225. The FTSE 250, though, which tracks mid-sized UK companies, was up over 170 points, gaining 0.76%. That divergence matters. The 250 is more domestically focused. It doesn't carry as much oil and mining weight as the 100. When oil spikes, the 100 gets carried by energy giants like BP and Shell. The 250 tells you what the UK domestic economy feels like. And right now, the UK domestic story has its own complications. The Palantir NHS contract story is creating political noise. The government launched a full review of Palantir's £330 million NHS deal. Separately, Palantir announced it intends to sue the mayor of London after he blocked a metropolitan police contract. That's a headline risk sitting on any UK tech-adjacent stock. In Europe, it was also a tricky day. The stock 600 slipped around 0.2% to 0.3% as the session progressed. The ECB meets tomorrow. A 25 basis point rate hike is widely expected. And with European inflation also sticky, investors weren't in the mood to buy the dip. HSBC fell 2.2% after a JP Morgan note flagged potential exposure to new Chinese banking regulations. SAP and Siemens Energy both dropped around 1.7%. ThyssenKrupp lost 3.5%. The bright spot in Europe? ST Microelectronics gained after BofA upgraded it to buy. A reminder that even in a down day, individual stock picks can outperform. If you want this briefing every single day, hit subscribe right now. We post every evening before the next session. Everything you need. None of the noise. Now here's the part that genuinely surprised even professional traders today. Gold fell sharply, in the middle of an active war. That is not normal behavior. And there's a very specific reason it happened that could tell you where gold goes next. Gold is down sharply today. It's hovering around $4,180 per ounce. That is down more than 2% in a single session. It's at its lowest level since late March. If you're watching a war escalate and wondering why gold is falling, here's the logic. War drives oil higher. Oil drives inflation higher. Inflation keeps the Fed hiking rates. Higher rates make gold, which pays no income, less attractive versus bonds. And here's the kicker. The US dollar strengthens in a rate hike environment. A stronger dollar makes gold more expensive for international buyers. So global demand drops. That combination, higher dollar, higher rates, lower demand, is crushing gold right now despite the conflict. Citi analysts made a striking call this week. They warned gold could fall another 20% by September, if the Strait of Hormuz stays closed through the summer. That would mean inflation runs hot, rates stay high or go higher, and the dollar keeps its bid. That's the bear case. The bull case? A ceasefire gets announced. Oil drops fast. The rate hike narrative cools. Gold bounces hard. For oil specifically, Brent at $93.95 today. U.S. crude inventories fell 7.2 million barrels last week, the seventh consecutive weekly decline, well above the 4 million expected. That draw tells you supply is genuinely tightening. The physical market is tight. If the strait stays restricted, $100 Brent is not a stretch. The clearest oil trade remains energy stocks. BP and Shell in the UK, ExxonMobil and Chevron in the US, or the XLE Energy ETF for a basket approach. Let's talk bonds, because this is where the real signal is sitting. The 10-year U.S. Treasury yield touched 4.55% today before settling at 4.52%. The 30-year bond yield is above 5%. These are not friendly numbers for growth stocks. They're not friendly for property. They're not friendly for any company that relies on cheap borrowing. When yields rise, bond prices fall. If you hold long-duration bond ETFs, like TLT in the US, you are losing money in this environment. Short-duration bonds are the better place right now. A 2-year US Treasury yields close to 4%. You get paid to wait without taking on long-term rate risk. For UK gilts, 10-year gilt yields are elevated, and the Bank of England is watching inflation carefully. A rate hike here before year-end is not off the table either. The trade being run by some professionals right now. TBT, a US ETF that profits when long bond prices fall further. It's a direct expression of the view that rates stay high or go higher. The key event tomorrow is the ECB decision. Expected 25 BPS hike. If they surprise with 50, European bond yields surge and stocks take another hit across the continent. Two major stories to close on. Oracle reported after the bell tonight. And this one is worth understanding carefully. Full-year revenues hit a record $67.4 billion, up 17%. Cloud infrastructure revenues surged 93% year-on-year. Earnings per share beat expectations at $2.11 versus the $1.97 forecast. Here's the issue. Cloud revenue for the quarter came in at $9.91 billion. Wall Street wanted $9.99 billion. An $80 million miss on a $9 billion number. Stock dropped over 6% after hours. That tells you how demanding the market is right now for AI-exposed tech names. Beat on earnings, fine. Miss on the AI growth metric even slightly, punished. Oracle also carries a $638 billion backlog of signed AI contracts. That's up from $553 billion just last quarter. The demand is there, but investors want proof it's converting to cash. Tonight's slight cloud miss raised doubt. Watch Oracle tomorrow at open. If it gaps down sharply, it could drag NASDAQ and broader tech sentiment lower again. And then there's SpaceX. Share pricing happens tomorrow evening. Trading begins Friday morning on the NASDAQ under the ticker SPCX. $135 per share. $75 billion raised. $1.75 trillion valuation. The largest IPO in history. OpenAI also confidentially filed for its own IPO this week at a potential $1 trillion valuation. What this means for existing holdings: massive IPOs pull capital away from current positions. To buy SpaceX, funds may sell Nvidia, Tesla, Microsoft. That's short-term selling pressure on tech this week and into Friday. The surprise part? The SpaceX pricing happens tomorrow night. As the Iran conflict is still live, CPI is digested, and Oracle's reaction is still playing out. This is a genuinely unusual amount of volatility to price around a record IPO. Keep positions sized sensibly. This is not a quiet week. That's everything that moved markets today, June 10th. The key things to watch tomorrow: the ECB rate decision, Oracle's open after that after-hours miss, SpaceX pricing in the evening, and any ceasefire developments that could flip oil and gold in seconds. Tomorrow evening, we'll be back covering all of it, including SpaceX's first print when it opens Friday morning. Make sure you're subscribed so you don't miss it. See you tomorrow.